Hello and welcome again. This is Robert Schein, Managing Director and Partner at Blanke Schein Wealth Management. Today is Wednesday, September 16th of 2020. Markets are moving. There's several headlines I want to report. You may not get them in your daily news cycle. So let's get right to what markets are paying attention to. Therefore, we should be too. Our first topic of the day is the Federal Reserve. They just concluded the two-day meeting of the FMOC, Federal Market Open Committee. Federal Reserve Chairman Jerome Powell is speaking right now as we speak, and he's actually moving markets. He's taking questions today after they just released the announcement saying they're keeping interest rates unchanged. So they're not going to raise their interest rates right now, and interest rates are at an all-time historic low for the Fed funds rate. So it's a welcome but not unexpected move. What was unexpected, what's moving markets, is sort of the commentary that really what we dig into as we watch and actually listen for what the Federal Reserve is communicating. Some of the key things that they described is they're going to, on a go-forward basis, not raise interest rates until they see the U.S. economy is getting back to where we were back in January and February. As they stated themselves, it was one of the best economies, if not the best economy, that the United States economy has experienced in a good long multiple decades, if you will. So we were very strong going into this, and we had a sub 4%, about 3.5% unemployment rate. And Federal Reserve Chairman Jerome Powell said that felt pretty good. And the reason why is you get to about sub 4%, around 3.5% full employment, is that broadens the economic expansion to basically everyone, right? The unemployment, not just for certain subsectors of the economy, but for men, women, and all different races, if you will. That's when the economy is truly humming on all cylinders. We saw that expansionary sort of number earlier this year, and the Federal Reserve pointed to that's one of their metrics on a go-forward basis prior to raising interest rates. Another key thing they talked about is they're going to allow the inflation target, which historically has been 2%, to run hot on a go-forward basis, which means interest rates stay low, real asset prices will start accelerating. There could be an asset bubble, maybe years down the road, and this starts today by their policy. It has in the past, the Federal Reserve. As I said before, it's easy for the Fed to sort of get into providing accommodations. It's hard for them. We have to watch the exit. So we're going to be over the next, 24, 36, 48 months. Again, it's also contingent upon the next administration, right? Because policy and monetary policy and fiscal policy will be working together on a go-forward basis, and after November it could change. We don't know. But that being said, it's going to be very interesting on a go-forward basis. The Federal Reserve is looking for the employment rate to get to about 3.5%. They say that looks good, feels good. They're going to allow inflation to run well over 2%, which is a different change. They're moving the goalposts, if you will. That's where the market's sort of questioning and saying, wait a minute, you're going to allow asset prices to run hot? And that's translation to the Fed is in full support. So asset prices will be supported by way of equities, by way of real estate, precious metals. You want to own in this window of opportunity, if you will, on a go-forward basis. And there's going to be tremendous volatility. We're seeing that play out right now because everyone's asking the Federal Reserve Chairman, well, what exactly does that mean? And you're going to get fits and starts along the way, but the backdrop is there for M&D S&L. It's mom and dad savings and loan. I don't know if you've ever heard this before. I gave it away, but it's mom and dad savings and loan. And quite frankly, it's talking about fiscal and monetary policy to be fully supportive for a full recovery. Again, the definition of full recovery, the Federal Reserve Chairman said 3.5% target for the unemployment rate. Well, we're about just over 8% right now, 8.4%. So that's going to be a long time. It could be 3-4 years before we get to the 3.5 full recovery. That means that mom and dad and fiscal, which is Congress, will be accommodative. So what's interesting here is that when the economy sort of stubs its toe, I think commercial real estate going forward, or all of the unemployment, benefits that need to be extended, the CARES or HEROES 2.0 Act. And actually, there's an update on that. I could be wrong. It's happened before, but Nancy Pelosi just talked about Congress, which is fiscal. They're not going to take their next recess until they actually get another bill out there to extend the unemployment benefits. I think the political environment is heating up, and it's also putting political pressure because there are Americans out there that do need the additional support from mom and dad savings and loan. So they realize that they just had a recess, they can't have another recess. They have to support the American people by way of more PPP for small business loans and a few other things that are targeted, especially the service industry that has been hit so hard. So what happens is you've got this dynamic between mom and dad. Okay, and it's good cop sometimes and bad cop. And if mom doesn't, provide sort of the extra help along the way when the kid needs it, or your children come to you, dad may be the sugar daddy at that moment in time, or the easy one to talk to. And roles can reverse depending upon family dynamics and how it all works, right? This is an old adage that we've used for many years. I joke about it in my own household when my kids ask for money. I'm like, oh, you guys are asking mom and dad savings and loan. And ultimately that means in our world, we have the fiscal monetary policy. We watch what they say. Why is that so important, Rob? Because we could have a change in the White House. We could have change in leadership at some point in time. It always will happen. Happens every 4 years and every 2 years, if you will, on those political cycles. But really what matters is where policymakers are doing, because they have the trillions of dollars at work, right? On one hand, the fiscal, which is Congress, can set our laws, but also our taxation. So that really dictates money movement. On the same time, monetary policy, the velocity of money, keeping interest rates low for longer, which just means that it's going to be fueling the real estate market on the residential side. Okay, there's some huge economic forces that are at play, as well as when they come in and provide that stimulus, as we saw as that gap stop earlier this year of $7 trillion right now. And they're looking, as I said before, Congress to come back and provide more assistance. That's just tremendous. You don't ever fight the Fed and you follow the money. In this case, it's our tax money, and who knows, that's another conversation for another day going forward of how we pay this back. And yeah, taxes are going to go up because we have to pay it back at some point in time, right? But in the meantime, interest rates are low, will be low for the foreseeable future. Markets are going to sort of process this going forward, and the Federal Reserve remains fully accommodative until we have a full recovery, and that's going to take some years. So thanks for watching today. Again, we just had our election edition earlier today. I had Bob Stein from First Trust. So if you missed that, please let Diane know and she'll get you a copy, as well as our election edition portfolio positioning. So thanks for watching. Until next time, take care.